What about those 7 stocks? Do you prefer to own those specific 7, or such as an ETF of the S&P, but you've got the other 493 as well?
Well, we actually use a combination of individual stocks through separately managed accounts as well as ETFs. And this comes back to optimizing a client's portfolio and where is the most efficient way to deploy capital in the equity markets. And so we have found that a combination of ETFs, direct drive right into the sector or into the market, is highly efficient to capture 100% of the upside. With separately managed accounts, it is possible to capture different percentage of upside downside capture. For example, with certain separately managed accounts, our experience is, let's say, 95% of the upside, but only 85-90% of the downside.
For big tech and also for those 7 that you were talking about earlier, do you think that there's still more room to run, that they're not overbought?
Well, they're clearly overbought if you look at them simply on the basis of the PE ratios. But I think we have to look at the market differently today than historically over the last 20, 30 years, simply because today the M7 can contribute 28% of the market value of the S&P, and they're trading at a significantly higher multiple than all the other stocks in the index. So that in turn leads to a higher overall PE ratio for the S&P. So we can't really look at today's levels and say, well, we've got elevated PEs, so the market's overvalued, simply because we've got, a higher proponent of growth stocks in there that have, wide moats. They've got recurring cash flows. They're growing faster than the S&P, and they deserve higher multiples.